Welcome to 5-Minute Philanthropy University, the quick resource for philanthropy planning, research, and marketing for busy professionals. This is your host, Professor Russell James, coming to you from the Department of Personal Financial Planning at Texas Tech University. Today's question is, how can I get an immediate tax benefit from a gift at my death? Well, if you put a gift in your will, that's great, but it creates no income tax deduction. Why? Well, it's because you could change your mind later and you don't get a tax deduction for something you could undo. But it turns out you can get an immediate income tax deduction if you irrevocably commit to a gift at death. Now, you can't do this through a will. Instead, you have to use something different, such as a remainder deed in a home or farmland or a charitable remainder trust. Let's take a look at the remainder interest deed. This gives the right to own the real estate after the death of the person who transferred that right. Unlike a will, a remainder interest deed is not revocable, and in fact it can even be sold by the charity or other person who receives it. A deductible remainder interest in farmland or a personal residence has to be transferred by a deed. It cannot be transferred by trust or contract in order to be deductible. Farmland, well, that's any land and its improvements that are used to raise crops or livestock, even if it's only used by a tenant to do that. A remainder interest can be gifted in any part of a farm or any share of the ownership in any part of the farm. Gifts of remainder interest can also be given in the donor's personal residence. Personal residences include second homes, vacation homes. It could even include a boat with bathroom, cooking, and sleeping facilities if it is used by the donor as one of the donor's residences. What is the charitable deduction for this kind of gift? It depends upon the interest rate environment and the age of the donor. So, for example, an age 59 donor transferring $1 million of farmland, if that transfer had taken place in a high interest rate environment, such as that we had in May of 1989, that transfer would generate a deduction of a little over $156,000. But the same transaction, if it was done in January of 2013 during a low interest rate environment, would generate over $800,000 of tax deduction. So it's a great technique for a low interest rate environment. The donor does have the right to continue to use the property for the rest of his life, but the donor must maintain, insure, and pay taxes on the property. If the donor decides to leave, the donor could rent out the property, could sell his right to use it for the rest of his life to somebody else, and in some circumstances, the donor could agree with the charity to a joint sale and divide the proceeds, or with some charities, the donor might be able to give the life estate to the charity in exchange for a gift annuity, or simply donate the life estate to the charity. Well, you can't do this through a will, but you can get a deduction if you commit to a gift at death through a charitable remainder trust. In a charitable remainder trust, the donor transfers money or property to a charitable remainder trust, and the donor receives income payments back from that for the rest of his life. Anything that's left over at death goes to the charity. These payments coming back to the donor can be a fixed dollar amount in a charitable remainder annuity trust, or a fixed percentage of all trust assets in a charitable remainder unit trust, where if the assets go up, the payments go up. The donor receives an immediate tax deduction for the present value of the amount that's projected to go to charity. How much of a tax deduction? Well, here's an example. A charitable remainder unit trust that pays 5% per year on an age 55 donor given in the year 2013 with annual payments starting right away. Well, for each $100,000 of money or property transferred, the donor gets a deduction of a little over $31,000. It turns out this IRS tax deduction is actuarially much larger than it should be because CRT donors tend to live longer than projected. That's because annuity purchasers in general live longer because sick people don't buy annuities. Also, wealthy people tend to live longer, and CRT donors tend to be very wealthy, and it turns out that charitable bequest donors live longer than others of their same wealth profile. In many cases, the donor can continue to act as the CRT trustee and even manage the assets similar to the way they managed them before. A final advantage, there are no capital gains taxes when a donor makes a transfer to a CRT, and when the CRT sells it, the CRT is a nonprofit entity and pays no capital gains taxes. That means the donor receives payments from the full value of the asset, unreduced by any capital gains taxes. This has been an episode of 5-Minute Philanthropy University. This is your host, Professor Russell James at the Department of Personal Financial Planning at Texas Tech University. Tune in next time as we review philanthropy planning, research, and marketing for busy professionals.